Almost all traders watching this video are aware of these candlestick patterns and use them to enter trades. But most of the time, their entries fail. For example, in this chart, the market trades in a range and then breaks below that range. As soon as you enter a short trade after seeing a bearish and gulping pattern on the chart, the market quickly reverses, trapping you. Similarly, you often enter trades by looking at candlestick patterns on the daily chart, but most of the time, you fail to make a profit. Therefore, in today's video, we'll learn some techniques for identifying candlestick patterns on the chart and entering trades at the right place. Every candlestick that forms on the chart mainly provides 4 important price values: the opening price, the highest price reached, the lowest price reached, the closing price. All candlestick analysis is built around these values. The larger the difference between the opening and closing prices, the larger the candle body becomes. If a candle closes above its opening price, it indicates that buyers were in control during that period. Conversely, if a candle closes below its opening price, it suggests that sellers dominated that time frame. For example, this 5-minute bullish candle closed above its opening price, showing that buyers successfully controlled the market during those 5 minutes. The next candle also opens lower and moves upward. However, the following candle opens at a higher level and closes sharply lower. This means buyers controlled the market during the first 10 minutes. But during the next 5 minutes, sellers outperform the buyers. Does this mean sellers have completely taken over the market? If you only look at the last 5-minute candle, you might think so. Now, many traders may ask, should we enter a short trade here? The answer is no. You should not immediately enter a short trade, because if you combine these 3 candles into a single 5-minute candle, you'll notice that the candle closes very close to where it opened. This indicates that neither buyers nor sellers have clear control because the price eventually closed near its opening level. This shows that sellers have completely failed to keep the market lower. As a result, after sweeping liquidity below the lows, the market moves higher to capture liquidity resting at higher levels. This is why you cannot rely solely on candlestick patterns when making trading decisions. If you do, you are more likely to lose money than make profits. Now let's understand the 3 main candlestick types that appear most frequently in both bullish and bearish markets. The first one is known as a big bullish candle or big momentum candle. These candles represent situations where either buyers or sellers establish overwhelming dominance in the market. That's why they are often called dominance candles. Whenever the market experiences strong momentum driven by high volatility, these types of candles often appear on the chart. However, most of the time, these candles are used to trap retail traders. For example, on this XAUUSD chart, a massive momentum candle appears after a period of consolidation. Many retail traders interpret this as a range breakout and immediately enter long positions. But shortly afterward, the market reverses lower and hits their stop losses, resulting in losses. After some time, price moves down and then forms another large bullish momentum candle. At this point, many traders think, this time the market will definitely continue higher. They enter another long trade. Unfortunately, the market once again reverses lower and hits their stop losses. Now the trader has already suffered 2 consecutive losses. As a result, they decide to stay out of the market until the range is clearly broken. Later, the market forms another large bullish momentum candle that appears to break the range. The trader enters a long position again, and once again, the market quickly reverses. Because of these large momentum candles, the trader has now been trapped 3 times in a single day. Large institutional traders often create panic and fear of missing out, FOMO, among retail traders. These candles are used to emotionally manipulate traders into entering positions at the wrong time. As retail traders rush into the market, liquidity is generated, making it easier for institutions to execute their large orders. Therefore, whenever you see candles that are significantly larger than normal candles, it is often safer to stay away from them. These candles only provide reliable opportunities a small percentage of the time. If you don't believe it, open your charts and verify it for yourself. Now let's move on to the next candlestick type. This candle is known as a reversal candle. Many traders also refer to it as a hammer candle or an inverted hammer candle. The defining characteristic of this candle is that the wick is much larger than the body. This long wick represents strong price rejection. The exact opposite occurs in a bearish reversal scenario, where price rejects from higher levels and moves downward. Whenever the market forms long wick candles near support or resistance zones, the probability of a reversal increases significantly. However, you should not enter a reversal trade until the market confirms the move by breaking out of the range. Once you enter the trade, you should remain in the position as long as no candle closes beyond the rejection area. That rejection zone effectively acts as support or resistance and helps protect your stop loss. This is why stop loss discipline is extremely important. Now let's discuss the third candlestick type, which is one of the most important candles every trader should understand. This candle is called an indecision candle. As the name suggests, it represents a situation where neither buyers nor sellers have complete control over the market. Many traders ignore these candles because they believe they provide little information. In reality, they often reveal some of the most valuable insights about market sentiment. This is why confirmation is always more important than prediction. Professional traders focus on confirmation. Amateur traders focus on prediction. The market rewards confirmation. Now let's discuss consolidation. Consolidation occurs when price moves within a relatively narrow range. During consolidation, buyers and sellers continuously exchange control, but neither side can establish dominance. This creates a balance between supply and demand. Many traders become impatient during consolidation phases. They attempt to predict breakouts before they occur. As a result, they frequently get trapped. Smart traders understand that consolidation is simply preparation for a larger move. The longer the market consolidates, the more significant the eventual breakout can become. However, not every breakout is genuine. This brings us to one of the most important concepts in trading: fake breakouts. A fake breakout occurs when price temporarily moves beyond support or resistance, attracting traders into the market only to reverse shortly afterward. Large institutions often use fake breakouts to generate liquidity. They know where retail traders place their stop losses. By pushing price beyond key levels, they trigger those stop losses and create liquidity for their own positions. This is why many traders experience the frustration of being stopped out just before the market moves in their original direction. The solution is not to chase breakouts. The solution is to wait for confirmation. A true breakout usually demonstrates several characteristics: strong closing prices beyond the breakout level, increased momentum, follow-through candles in the same direction, retest that successfully holds support or resistance. Without these elements, the probability of a fake breakout remains high. Remember this: the market's primary objective is not to reward impatient traders. The market rewards discipline, patience, and risk management. Every candlestick tells a story. A bullish candle tells the story of buyer strength. A bearish candle tells the story of seller strength. A reversal candle tells the story of rejection. An indecision candle tells the story of uncertainty. Now, let's bring everything together and understand how professional traders read candlesticks in real market conditions. Most beginners focus on memorizing candlestick patterns. They spend countless hours learning the names of different formations: hammer, shooting star, engulfing pattern, doji, morning star, evening star. While these patterns can be useful, relying on them alone is a mistake. Whenever you analyze a chart, ask yourself these questions. Where is the market located? Is price approaching support or resistance? Is the market trending or consolidating? Has liquidity recently been taken? Who currently has control, buyers or sellers? Is momentum increasing or decreasing? The answers to these questions provide far more value than simply identifying candlestick patterns. Now let's discuss risk management. Even the best candlestick setup in the world can fail. No trading strategy wins 100% of the time. Losses are a normal part of trading. The goal is not to avoid losses. The goal is to control them. This is where proper risk management becomes essential. In highly volatile markets, strict risk management is often the difference between long-term survival and account destruction. Professional traders typically risk only a small percentage of their account on each trade. A common standard is between 1% and 2% of total account equity per position. This approach ensures that a series of losing trades does not significantly damage the account. At the same time, traders should focus on maintaining favorable risk-to-reward ratios. Remember, you do not need to win every trade. You only need a consistent process. Trading success comes from executing the same high-quality process repeatedly over a large sample of trades. The market will always contain uncertainty. No candlestick pattern can eliminate that uncertainty. However, by understanding candlestick psychology, market structure, liquidity, momentum, and risk management, you can dramatically improve your decision-making. The next time you open a chart, don't just look at the candles. Ask yourself, what story are they telling? Who is winning the battle between buyers and sellers? Where is liquidity likely resting? What is the market trying to accomplish? Thank you for watching. If you found this lesson valuable, consider sharing it with another trader who may benefit from it. Keep learning, stay disciplined, manage your risk, and continue improving one trade at a time. See you in the next lesson.